Welcome back to the deep dive. It is Monday, January 26th, 2026. Usually we like to ease you into the week with some gentle trends, maybe a nice bird's eye view. But if you have glanced at your charts, checked the weather radar, or read, I don't know, a single headline in the last day, we don't have that luxury. It is, to put it mildly, messy out there.
Messy is being generous. I mean, I've been staring at the terminal all morning.
Mm.
What we're looking at is a textbook convergence of storms. And I mean that literally and figuratively. You have a meteorological storm freezing infrastructure in Texas, a financial storm hitting risk assets, and a regulatory storm brewing in the UK.
It really feels like everything is happening all at once. So our mission today is to just unpack the intelligence briefing from the last 48 hours. We're going to try and figure out why the market is acting so defensively, this real risk-off mood, even though, and this is the confusing part, we're seeing some absolutely massive corporate buying.
That's the paradox we have to solve. I mean, the headline of the briefing is supply dominance. That's the theme. So we need to understand what that actually looks like when you've got miners shutting down, banks blocking transfers, ETFs bleeding cash, all while one giant is trying to buy everything.
Right. So we've got a roadmap. First, we're going to tackle what the briefing calls the divergence trap. That's Strategy Inc. Buying billions while the price just keeps dropping. We need to get into the mechanics of that. Then we're heading to Texas, the virtual power plant thesis, and why miners shutting down is maybe a feature, not a bug.
And finally, we have to talk about the quantum leap. This is the part of the briefing that, honestly, it really stopped me in my tracks. Ethereum is suddenly treating quantum computing not as some distant sci-fi thing, but as an immediate threat. And that changes everything.
That last part is genuinely unsettling. We'll get there. But let's start with the whale in the room, Strategy Inc., formerly MicroStrategy. They've been incredibly active.
It's extremely active. Between January 20th and the 25th, so just in the last 5 days, they scooped up another 2,932 Bitcoins. That's a capital deployment of what, about $264.1 million?
Which is just a staggering amount of money to deploy in less than a week. But here's where it gets interesting, and honestly, a little painful if you're a shareholder watching the ticker. The briefing highlights the specific watermark detail. Their weighted average price was $90,061.
Right. And if you check the spot price right now, we're hovering, what, 87, 88,000?
So they're underwater on this purchase immediately.
They are. And that distinction is significant. This is what we call high conviction bid support. Strategy Inc. isn't buying a breakout. They are trying to catch a falling knife. They're acting as the liquidity provider of last resort. When everyone else is selling, they're stepping in to absorb that supply.
But clearly, even $250 million wasn't enough to hold the line at 90K. The price dipped anyway.
Exactly. The selling pressure, which we'll get to, was just too strong. But the fascinating part here isn't just that they bought, it's how they bought. They didn't just have that cash sitting around.
Right. The briefing mentions the ATM offering, and I'm pretty sure they didn't go to a cash machine in the lobby. Can you break that down?
It's financial engineering at its peak, really. ATM stands for At the Market Equity Offering. Essentially, Strategy Inc. sold $257 million worth of their own stock, their Class A common stock, into the open market.
Okay, let's just pause on that. They are printing new stock, selling it to investors,
Yes.
and using that cash to immediately buy the underlying asset.
In a nutshell, yes. They are arbitraging the demand for their own company. As long as the stock market values them at a premium to the Bitcoin they actually hold, they can just keep doing this. Issue shares, buy more Bitcoin, and, in theory, increase the amount of Bitcoin per share.
It sounds like a perpetual motion machine, but it's got to rely entirely on that premium holding up, right? If the stock crashes, the machine breaks.
It does. It's a dilution machine, but it's supposed to be accretive dilution. But, and this is a huge but, it doesn't always work out. The briefing brings up this Japanese firm, Metaplanet. They're having a much rougher time.
Yeah, I saw that. They've been trying to be the Strategy Inc. of Asia, but they just reported a massive loss.
Massive. An impairment loss of 104.6 billion yen. That's about $680 million.
Ouch. Now, for those of us who aren't accountants, is that real money lost, or is that just, paper shuffling?
It's a paper loss, mostly, but it has very real consequences. Under their accounting standards, if the asset price drops, you have to write it down and take a hit on your earnings. Metaplanet's stock dropped 7% in Tokyo on the news.
So the takeaway is that this corporate treasury model isn't free money. It brings massive volatility with it.
Exactly. It shows you the difference between an ideological allocator like Strategy Inc., who ignores the quarterly noise, and, well, the market's patience with everyone else. Investors in Tokyo got spooked.
Speaking of corporate adoption, I did find one little detail in the report that was just surprisingly wholesome, I
The
guess.
steak and shake moment. Yeah, that was the palate cleanser in the briefing.
They're offering a Bitcoin bonus to employees.
It's a fascinating signal, isn't it?
Mm.
Starting in March, hourly workers get a bonus of 21 cents worth of Bitcoin for every hour they work.
21 cents for the 21 million supply cap. Very clever.
It's symbolic, sure. But think about it. It's a retention strategy. What's really interesting is that we're seeing adoption move from the corporate treasury, the billionaire CEO level,
Mhm.
down to direct labor incentives. Even while the market is bleeding, you've got people flipping burgers and accumulating sats. It's a sign of normalization we tend to overlook.
I love that. It grounds all this high finance stuff in reality. Okay, but let's pivot from burgers to something much, much colder. We need to talk about Texas.
Winter Storm Fern.
This sounds serious. The briefing calls it a network stress test. Walk us through what happened.
It was a massive disruption. Temperatures plummeted, demand for heating went through the roof, the grid was pushed to 86 gigawatts. And in response, the Bitcoin miners did exactly what they've always promised to do. They shut off.
And the numbers are wild. Foundry USA, the biggest pool, saw its hash rate drop by 60%.
60%. That's about 200 exahashes per second just vanishing.
Mm.
Globally, we probably lost somewhere between 25 to 35% of the entire network's computing power in a few hours.
Okay, so for the listener who hears that and thinks, oh no, the network is breaking, why is this actually framed as a positive in the report?
Because this is the virtual power plant thesis in action. You have to look at the economics. In Texas, miners have these agreements. When the grid gets stressed and electricity prices spike, it becomes way more profitable for them to sell their power back to the grid than to mine Bitcoin.
So they act like a battery or an energy relief valve.
A relief valve is a great way to put it. They are a load balancer. They're the only industrial consumer that can shut down almost completely in 5 seconds without breaking anything. An aluminum smelter can't do that. So miners shut down to free up power for homes and hospitals. They stabilized the Texas grid.
That makes sense for the grid, but there were consequences for the Bitcoin network.
Oh, definitely. The network didn't break. Security was fine, but it slowed way down. Block times, which are supposed to target 10 minutes, stretched out to over 15.
And when blocks are slow, space is scarce.
Which means fees spiked. The factory was producing less product, so the price to get your transaction on the belt went up. But the key here is that the network degraded gracefully. It didn't crash. It just got slower and more expensive, which is exactly what it's designed to do.
It's amazing that a storm in Texas can slow down a transaction in Tokyo. It just shows you how physical this all is. But speaking of global connections, let's move to the global fracture.
Yeah, and this connects right back to that supply dominance theme. While miners are either selling or shutting down, we're also seeing liquidity choked off from the demand side, specifically in the UK.
The soft ban. This is really concerning. A survey showed UK banks are blocking or delaying 40% of transfers to crypto exchanges.
40%. That is a massive friction point. And remember, this isn't a new law. This is just the banks themselves, Chase. TSB making their own risk policies.
They call it a choke point strategy in the briefing. What's the logic there?
It's about not banning the asset, because that's hard. You just make it impossible to buy. It throttles retail capital from a G7 economy. So if you're a regular person in London trying to buy this dip, your bank just says no. That removes a huge amount of buy pressure.
And it's not just the UK. The report mentions India is cracking down hard, specifically on privacy.
Yes, the FIU in India has effectively banned privacy coins like Monero and Zcash. They've also blocked 25 offshore exchanges. They're forcing everyone into what you could call compliant zones. If you're not on an exchange where your ID is tied to every transaction, you're being cut off.
So UK blocking transfers, India banning privacy. But then you look at Japan, and it's a completely different story.
Japan is the total outlier. The report indicates they are moving toward approving crypto ETFs by 2028.
2028 feels far away, but it's a positive signal, I suppose.
It is. It just shows the world is fracturing. You have hostile jurisdictions, and you have integrating jurisdictions. The regulatory map is no longer uniform at all.
Okay, let's shift gears completely. We've done finance, infrastructure, politics, now tech. And I have to be honest, this part of the briefing gave me pause.
You mean the quantum pivot?
Yes. The Ethereum Foundation has officially formed a post-quantum team.
This is a major signal. For so long, quantum computing was this distant sci-fi thing, maybe 10, 20 years away. But the EF moving from research to active engineering, that tells you the timeline has accelerated.
Can we break down the threat? Why is a quantum computer so scary for crypto? It's just a faster computer, right?
That's not just faster. It solves problems in a fundamentally different way. It comes down to the lock on your digital vault. Right now we use something called ECDSA, elliptic curve encryption. It's incredibly secure against normal computers.
But a quantum computer changes the math.
Exactly. A sufficiently powerful quantum computer could, in theory, calculate your private key just from your public key.
It picks the lock.
Instantly. It would break the encryption that protects every current wallet. The entire premise of secure value evaporates.
That sounds apocalyptic. So what's the solution? Is the whole chain being rebuilt?
They're building new defenses. They're funding things called hash-based signatures, Merkle signatures, SFIN CS plus Jur. Basically, these are cryptographic methods that quantum computers can't easily break. The problem is, these new signatures are heavy. They take up a lot of data.
And data on a blockchain is expensive, so transaction fees would be astronomical.
Precisely. So the Ethereum team is looking at wrapping these heady signatures in Stark's zero-knowledge proofs to make them smaller and more efficient. That's the active engineering part.
This is where it gets really interesting for anyone just holding assets. The briefing mentions a liveness requirement.
This is the aha moment. This changes the behavior of every single hodler.
Yeah, explain that, because I think most people believe the safest thing you can do is put your crypto on a hardware wallet and bury it in the backyard for 20 years.
And that used to be true. But the quantum threat changes what cold storage means. Eventually, the network will have to upgrade to this new quantum-resistant standard.
Yeah.
And when that happens, you will have to move your funds. You will have to sign a transaction with your old key to migrate them to a new quantum-safe address.
So if my wallet is buried in the backyard and I miss the upgrade memo?
If you leave it too long and a quantum computer comes online before you migrate, your old wallet is a sitting duck. A thief could derive your key from the public ledger and just empty it.
So passive holding is dead.
Set it and forget it is becoming dangerous. Passive holding is now an active technical responsibility. You have to pay attention.
That is a fundamental shift in mindset. Before we wrap up, there was one more note. Gemini is closing Nifty Gateway.
Yeah. For anyone who remembers the 2021 NFT boom, Nifty Gateway was the center of that universe.
It was, people, all of that.
And now it's being shut down. It's a clear signal that the growth at all costs era for collectibles is over. The infrastructure is consolidating around finance yield, custody, payments, not art.
So what does this all mean? Let's try to synthesize this.
Well, the big picture is that we are in a period of supply dominance. That's the key phrase. You have ETF outflows, about $1.7 billion. You have miners in Texas capitulating. You have UK banks blocking retail.
That is a lot of selling pressure and block demand.
It is. And on the buy side, you basically have Strategy Inc. trying to hold back the tide. It's a valiant effort, but it's just not enough.
So what are we watching in the next 48 hours? What really matters?
Three things. First, the price. Watch $87,000. If that support breaks, the briefing suggests $84,000 is the next stop.
Second,
The hash rate. We need to see Foundry USA come back online as Texas thaws out. If they don't, network fees are going to stay painful.
and finally, the macro picture.
The Fed. The FOMC meeting is happening. There's a government shutdown looming. We need to know if the Fed will acknowledge that risk. If they sound dovish, we could see a bounce. If they stay silent, the risk-off mood continues.
It really is a perfect storm. You know, I think that phrase you just used, crypto agility, is the most important takeaway here.
I think so. Whether it's moving funds because of a bank ban or preparing to migrate your keys because of a quantum threat.
The days of buying, burying, and forgetting are over. The future belongs to the agile.
Couldn't have said it better myself. Stay warm and stay alert.
Thanks for listening to The Deep Dive. We'll catch you on the next one.